Hi, everyone. Hope you're doing well and hope you came to learn. My name's Avery Bundy. I'm a senior here at Franklin College, and today I'll be presenting you Section 168K, Bonus Depreciation. So, what is bonus depreciation, and how can an individual take advantage of it in order to help their return? In 2001, the United States government initiated Section 168 of the International Revenue Code, which became known as bonus depreciation. This section of the IRC provides businesses the opportunity to take a portion of their recently purchased assets and deduct them from their taxable income. Then in 2017, the U.S. Congress passed the Tax Cuts and Jobs Act, otherwise known as TCJA, which impacted how bonus depreciation is currently used. Recently, the U.S. Congress passed the Coronavirus Aid, Relief, and Economic Securities Act, which further impacted how business depreciation can also be used. Thus, bonus depreciation has played a pretty significant role for business tax returns since 2001 and its inception, which has led me to inspect what it is, how it changed before and after the Tax Cuts and Jobs Act, and the advantages and disadvantages that are associated with it. So now let's talk about the what, how, and why of bonus depreciation. So what is bonus depreciation, you might be asking? Well, bonus depreciation is another name for the additional first-year depreciation, which it allows businesses to write off large portions of their capital expenses within the first year that they are recorded. So how does bonus depreciation work, you might be saying? Well, as stated by Tax Foundation, under current law, bonus depreciation allows businesses to deduct 100% of total cost of their eligible investments in the first year. Keywords here being eligible investments, which we'll learn about a little bit later. So this means the businesses incur large amounts of depreciation expense sooner, which helps to lower their taxable amount on their return. So why should a business use the bonus depreciation? Well, simply, bonus depreciation should be used on new capital equipment for the particular reason that it allows businesses to not understate costs, thus allowing businesses to show true profit and decrease the company's tax burden. So now we're going to talk about some items that actually help qualify for bonus depreciation. So according to the IRS website, there are 4 requirements for bonus depreciation. These 4 requirements are listed here. They include the depreciable property must be a specified type. The original use of the property must commence with the taxpayer, or the depreciable property must meet requirements under Section 168K to EII. The depreciable property must be placed in service by taxpayer within a specific time period, or must be planted or grafted by the taxpayer before a specified date. And the depreciable property must be acquired by a taxpayer after, again, that's after September 27th, 2017. If the property of the business qualifies under these above conditions, then the company can choose to take or forego bonus depreciation. However, if a company chooses to forego the deduction, all qualified property must forego the deduction. If a company does choose to use bonus depreciation, where would it be found, though, you might be asking? Well, that's what I'm about to show you next. So if a company is trying to find, or if an individual is trying to find if a company is using bonus depreciation, they really should go to Form 4562, and you can simply just do that by going to the IRS website. Here, I kind of got it outlined for you, but if you look at line 14, it says Special Depreciation Allowance. Right here is actually where you would see if a company has any bonus depreciation at all. Well, you might be saying, though, what about, is there anywhere else? Well, yeah, there actually is. So bonus depreciation, if a company uses it, it'll be on that Form 4562, which is the form for depreciation and amortization, but it also will flow to Form 1120, Here it'll be on line 20, which is the depreciation and amortization amount. And I don't know if you can see it very well, but here on line 20, it says depreciation from form 4562. So that just flows through to this document. All right, so now let's talk about bonus depreciation before the Tax Cuts and Jobs Act. All right, so a little bit of the application before the Tax Cuts and Jobs Act. So before the TCJA, the United States government still offered bonus depreciation. However, it was tremendously different compared to what it is now. So since 2001, bonus depreciation has existed as Section 168K of the IRC, which we kind of talked about earlier. However, during this time period, the deduction was 50% of the adjusted basis of qualified property. So for any property to qualify, not many restrictions really existed back then, except it had to be considered new, and it could be considered qualified improvement property. This definition of bonus depreciation might be a little bit easier to see if we look at a case. So let's go ahead and look at January transportation versus the IRC, or the U.S. Commissioner. All right. So in 2008, the International Revenue Service lawsuit against January Transportation, Inc. Finished in the United States Tax Court. The IRS believed that the January Transportation, the taxpayer in this situation, was liable for over $18,000 of accuracy-related penalties under the U.S. Section 26. Here, this section of the U.S. codes implicates any portion of underpayment of taxes required to be shown on a return. There shall be added to the tax an amount equal to 20% of the portion of the underpayment to which this section applies. So basically, what was the main issue in this case? The IRS was arguing that January Transportation was liable for an accuracy-related penalty. Here, the accuracy-related penalty actually dealt with bonus depreciation, and whether the assets were eligible for bonus depreciation that January Transportation used. Basically, they were saying that the ones they did use didn't meet the above requirements that we talked about just a second ago, of basically just being a new or qualified improvement property. So when the case went to court, it was determined that the taxpayer had an underpayment to their 2002 return. So in this case, the IRS was able to establish that January Transportation's underpayment exceeded their amount that they were able to take on bonus depreciation. The taxpayer then argued that the penalty shouldn't have been assessed because no penalty should be imposed under Section 6,662 or 6,663 with respect to any portion of underpayment if it is shown that there is a reasonable cause for such portion and the taxpayer acted in good faith with respect to such portion. However, the court found that the taxpayer's intended defense did not imply. Also, the court was able to determine that the taxpayer and their tax preparer had coerced together in order to give the taxpayer bonus depreciation deduction for an aircraft and in timeshare condo that did not qualify under Section 168 qualified assets. If one recalls from earlier during 2002, the requirements for bonus depreciation before the Tax Cuts and Jobs Act would be implied. These assets just simply didn't qualify under those. So that's why the court found in favor of the IRS in this case. So now that we've learned about bonus depreciation before the Tax Cuts and Jobs Act, let's figure out how it was impacted after. So in 2017, the United States Congress passed President Trump's Tax Cuts and Jobs Act, otherwise known as the TCJA. Under this new act, bonus depreciation shot up 50%, or from 50% of the adjusted basis to 100%. So further stipulations were added to qualifying property that included the property be placed in service after September 27th, 2017 and before January 1st, 2023. So these stipulations go even further. So they drop the total first year deduction to a justified basis from 100% to 80%, 60%, 40%, and 20% in each year following 2022. So the Tax Cuts and Jobs Act also increased the types of assets qualified for bonus depreciation as long as the cost recovery was 20 years or less. So this gave more qualified property and items. However, long-lived capital investments such as structures didn't qualify for bonus depreciation. So items that would qualify under this new thing would be short-lived investments such as machinery, equipment, vehicles, cameras, and other things like that. Basically, under this new plan, incentivizes businesses to make investments sooner for assets that qualify in order to take full advantage of the 100% deduction. However, one big misunderstanding that happened with the Tax Cuts and Jobs Act was qualified improvement property. Here, QIP is the interior improvements to an existing non-residential real property. QIP was originally part of bonus depreciation, yet it was inadvertently removed from the qualified property under the Tax Cuts and Jobs Act. Basically, it was removed because it failed to meet the marks requirement under the new thing. So you can imagine that this could really impact a business because they could be making improvements to their property thinking that they were going to get it, and then we're going to get bonus depreciation, and then they weren't able to. So we're going to go ahead and we're going to talk a little bit about a case that fits under this example with Wells v. the Commerce, or the IRS, essentially. So in 2019, the United States Court of Appeals for the 10th Circuit took a case for Wells versus the IRS. Initially, the United States court heard this case, our tax court heard this case, and ascertained a verdict. Here, the petitioner, Marion Wells, sued the IRS commissioner in hopes that their 2010 and 2011 expenditures could be deducted under the IRC Section 162. Under IRC Section 162, there should be a deduction for ordinary and necessary expenses that include salaries and other compensations, travel expenses in pursuit of a trade or business, and rentals for use of trade or business. The U.S. Tax Court held that the expenses were not allowed to be deducted because they were capitalized. The work on the road was a replacement cost and had to be capitalized, and therefore they found that $9,000 was deductible under Section 162. Thus, the United States Tax Court deemed that the amount of the taxpayer wanted to collect for bonus depreciation was not eligible. So basically, frustrated by these previous rulings in the tax court, Wells appealed the decision, and this went to the United States Court of Appeals for the 10th Circuit. Here, the court is in charge of determining whether the prior court's verdict is accurate, not necessarily that it's and rules in favor of the IRS or Wells. So the tax court originally denied the taxpayer's motion for consideration for expenditures for bonus depreciation. The Court of Appeals actually ruled that this decision from the tax court was accurate because this case needed more information, and the determination was based on a waiver. Essentially, Wells, the taxpayer, was unable to demonstrate that her expenditures met the requirements that we talked about earlier for bonus depreciation. And so because of that, she was wrong, or she needed to be able to further prove that. And because she couldn't prove it, the appeals court, the appellate court, they ruled in favor of the tax court's decision. So now let's talk about how the CARES Act affected bonus depreciation. So in March of 2020, the United States Congress released the Coronavirus Aid, Relief, and Economic Securities Act, otherwise known as the CARES Act. The CARES Act included in it a revised treatment of depreciable assets, mainly with QIP. Basically, this was to fix the earlier mistake with the Tax Cuts and Jobs Act. So QIP was now qualified because it made it within the right period and used marks. So now I'm gonna give you guys kind of a basic example. So feel free to pause the video here if you want to kind of try to go and work through this yourself. But I'm gonna talk to you guys through this basic example. So basically, Ramon's Plumbing buys a new machine for $18,000 from a supplier for use in his new business. Ramon sells the machine a year later to Kenny's Heating, Cooling, and Plumbing for $6,000. Kenny also adds into his business in a transaction classified as qualified improvement property that costs $3,000. Finally, Kenny purchases a vehicle for work purposes only that cost $10,000. How much can Ramon and Kenny's businesses purchase? How much of the purchases can qualify for bonus depreciation? So I'm going to walk you guys through how it would be affected before the Tax Cuts and Jobs Act, after the Tax Cuts and Jobs Act, and then also after the Tax Cuts and Jobs Act and the CARES Act. So before the Tax Cuts and Jobs Act, so prior to 2017. So for the period prior to 2017, Ramon would assume that the machine had an estimated life of less than 20 years and can deduct $50,000 or 50%, of the cost of the machine as bonus depreciation. So his bonus depreciation total deduction should be $9,000, which results from 50% of the $18,000 that he paid. So for Kenny, however, in the period prior to the TCJA, deductions, he cannot deduct any of the machine's costs because it's a secondary purchase. Also, prior to that, vehicles did not count as qualified property for bonus depreciation, so Kenny doesn't receive anything from this as well. However, in the period before the Tax Cuts and Jobs Act, QIP, or the qualified improvement property, is eligible. So therefore, Kenny can take 50% of the cost of QIP, giving Kenny a total bonus depreciation of $1,500, which is found by taking the $3,000 for QIP and multiplying it by 50%. So after the Tax Cuts and Jobs Act, but before the CARES Act, so for this period after 2017, Ramon, he's able to assume that the same situations as above. Basically, he can deduct 100% of the cost of the machine. So, here, his actual total bonus depreciation would be $18,000. So for Kenny, however, in the period after the Tax Cuts and Jobs Act, but prior to the CARES Act, he can deduct the amount of the machine because previously purchased assets now qualify. Also, the vehicle purchased from Kenny business now qualifies. So finally, however, though, the misprint for the Tax Cuts and Jobs Act regarding QIP makes that amount ineligible. So with the Tax Cuts and Jobs Act, the amounts are now 100% deductible as well. So therefore, Kenny can deduct $16,000, which is $6,000 and the $10,000 that he paid. Now, let's look at after the Tax Cuts and Jobs Act and after the CARES Act. So this is from 2020 till now. So for the period after the CARES Act, Ramon can still deduct the 100% cost. So he's still going to get $18,000. So for Kenny, in the period after that, though, he can still deduct the entire amount of the machine. Also, he gets he still gets the vehicle, and then he also after the CARES Act, it reinstated qualified improvement property to 100%. So therefore, Kenny can deduct $19,000, which is the $6,000 plus the $3,000 for QIP, and then plus the $10,000 for his bonus depreciation. So now that we've run through some basic examples, let's kind of talk about some advantages, and then we'll get into some disadvantages of bonus depreciation. So advantages. So there are several reasons why a business should consider using bonus depreciation, which include reducing startup deduction, higher upfront deductions, and it works as a tax deferral. While bonus depreciation doesn't actually decrease the cost of starting a business, it does reduce the amount of tax debt from a startup expense, thus giving the business back more money by decreasing the total taxable amount. Then bonus depreciation also allows for higher upfront deductions by reducing the current tax bill. This allows for if your business is having short-term cash flow and any delayed deduction. The last advantage is a tax deferral, in which bonus depreciation allows for a business to defer a portion of its tax debt. This gives businesses extra time before they must pay their taxes in full. So other advantages, according to Gunther, which is a source I used, include increasing the cash flow of investing firms and giving firms an incentive to make qualifying investments. Bonus depreciation increases cash flow by decreasing the taxable amount for a business's return. With a lower taxable amount, this leads to the business owing less to the federal government and thus increases their cash flow. This extra amount also allows for the firm to increase their purchases of investment, which Gunther argues will lead to businesses purchasing more qualified assets to continue lowering future taxable amounts. So that's just kind of some of the advantages. Now let's talk about some of the disadvantages. So basically, with every option there is in the world, you have something good about it, but there also could be something bad. So for bonus depreciation, the disadvantages include lower future deductions. It is regarded as a clear preference and raises the risk of recapture depreciation. When a bonus depreciation is used, one must understand the full amount of depreciation is used in the first year. This actively demonstrates that when the depreciation is used in the first year, it cannot be used in the future years that the business holds that asset. This actually can hurt a growing business because it limits the choice of the business has to reduce future taxes with the potential of raising the business into a higher tax bracket in the future. According to Rigello, another site I use, individuals who oppose the use of this system argue that it has a clear preference as well, and it can lead to a distortion of businesses' decisions of what, when, and how much to invest. So basically, you would only be investing in qualified investments, and a lot of businesses need to invest in other things that aren't qualified, so it can kind of blur their vision there. Lastly, when a business uses the bonus depreciation, they can run the risk of recapture depreciation. This occurs when the business sells an asset before it is deemed worthless based on its depreciation schedule, and it is sold at a higher value than the existing accounting value. This means the IRS will take the portion of the deduction back that was sold over the accounting value. So another disadvantage that Gunther, which is the source I used earlier, kind of argues for bonus depreciation is that it lessens the federal tax burden on upper income business owners. So here, Gunther argues that larger corporations will be able to take a bigger advantage of using the bonus depreciation laws. This means that the government will receive less money from large corporations that are able to use the reduction for bonus depreciation. Basically, Gunther here argues that it is going to hurt lower classes more because while they can still use bonus depreciation, smaller businesses won't be able to deduct near as much as what larger businesses will be able to do. And larger businesses can basically use that deduction to offset anything that's major for them, thus paying less to the federal government. So, in conclusion, basically, as seen from the above information that we've been talking about, bonus depreciation has been extremely useful deduction for businesses in the United States since 2001. Before the Tax Cuts and Jobs Act, bonus depreciation allowed for 50% deduction of qualified property. After the Tax Cuts and Jobs Act, the amount of items that qualified for bonus depreciation increased, and the deduction increased from 50% to 100%. Yet, qualified improvement property was lost its eligibility under the qualified items. Recently, however, though, bonus depreciation was affected again by the Coronavirus Aid, Relief, and Economic Stability Act, which introduced the eligibility of QIP to the qualified property. Bonus depreciation has its disadvantages that include lower future deductions, clear preference, and raised risk of recapture depreciation. Yet, bonus depreciation has also several advantages that include reducing startup deductions, higher upfront deductions, and it works as a tax deferral. Although bonus depreciation has been affected several times since its inception and has disadvantages associated with it, the advantages of bonus depreciation outweigh all of the negatives. Thus, bonus depreciation should be considered by all businesses when purchasing assets and expenditures or trying to reduce their taxable amount. As part of this project as well, we were asked to do some limitations and further research. So if I could continue research on this topic, I would want to determine the estimated impact that bonus depreciation has under the Tax Cuts and Jobs Act if no phasing out period existed. Also, I would like to see how it affects it would be if long-term investments were allowed to be qualifying property. That would mean businesses could deduct 100% of qualified property, and it would eliminate any clear bias that the Tax Cuts and Jobs Act had. Nevertheless, the Tax Foundation estimates that if 100% bonus depreciation became permanent, there would be increases in the GDP, wage rate, private business capital stock, and full-time equivalent jobs. I'm unsure as to how accurate this information is, and I would want to further the amount of research that York and other authors did on that. Another area I would like to do further research on is how the federal government is affected by corporations using bonus depreciation. Besides the obvious fact that they receive less money from corporations, experiencing less taxable income basically on their return, I would also want to invest time into figuring out more that the government is affected by. Also, I would like to do further research on Section 179 deduction and how it ties to Section 168. I know that these two sections are used as a deduction on a return. However, I want to know more about how businesses strategically use them and how they can be further developed. And that is kind of the end of my presentation, guys. Feel free to reach out if you have any further questions. And here are some of my references. Awesome. Thank you and have a great day.